So as we all know, macro-financial and external conditions are constantly changing, and regulatory authorities and banks need to keep pace with new developments like climate change, financial innovation, and even crisis. Coming up next, we have our first panel discussion of the day, and we've brought together a stellar lineup of experts to talk about their topic. Joining this panel are Ms. Victoria Saporta, Executive Director, Bank of England, Mr. Makoto Minegishi, Deputy Director General, Bank of Japan, Mr. Wayne Byers, former Chair, Australian Prudential Regulation Authority, and last but not least, Mr. Bill Winters, Group Chief Executive, Standard Chartered Bank plc. And chairing our panel today is Mr. Norman Chan, former Chief Executive of the Hong Kong Monetary Authority. We're just about ready to have reset our stage. So ladies and gentlemen, can you please join me in giving all our panelists and our panel chair a very warm welcome as they come to the stage.
Vicky? Hi, good morning, everybody. I'm very, very pleased to be here. Thank you, Eddie. Thank you, John Tao, for having me for this BIS HKMA Joint Conference. It also is part of the event to mark the 30th anniversary. I was there 30 years ago, and very, very feel attached to this important date. Eddie said, all right, Hong Kong is back, but you need evidence because in a world you require evidence. I tend to think that supervisors and central bankers are very risk-averse. Seeing so many friends, supervisors from abroad traveling to Hong Kong without a mask on, it's a clear and undoubted validation that Hong Kong is really back. I just a simple plea for all of you coming from overseas. After this conference, do go out, walk around, and do some shopping. All right, Art Basel is okay, but it's a bit expensive to me. We need every tourist dollar from you guys. Now, I have today a very distinguished panel of speakers. They're all leaders in the banking world, and we are fortunate to have their presence joining us to share their insights and wisdom with us. Let me introduce briefly, individually, Victoria Saporta, Vicky, we call her, is the Executive Director for Prudential Policy in the Bank of England and Prudential Regulatory Authority. She has held a number of positions in regulatory policy, financial stability, and monetary analysis in a career spanning over 25 years at the Bank of England. Vicky is currently chair of the Executive Committee of the International Association of Insurance Supervisors. She's also a member of the BIS. Next to Vicky is Makoto Minegishi-san. He is the Deputy Director General, Financial System and Bank Examination Department at the Bank of Japan. Makoto-san joined the Bank of Japan in 1994, and he currently represents the BOJ on the BIS. Wayne Byers, he concluded an 8-year term last year as chair of the Australian Prudential Regulation Authority, which is Australia's prudential regulators of banks, insurance companies, and pension funds. Very powerful person. Prior to his position as chair of APRA, Wayne was the Secretary General of BIS in 2012 and 14. During a period of very substantial reform to the international banking supervision. So BIS is very familiar to Wayne. Last but not least, Bill Winters. He's a very seasoned veteran in the banking field. He's the Group Chief Executive of Standard Chartered plc since 2015. Before that, he spent 26 years with JP Morgan in different kind of leadership roles and was co-CEO of the investment bank from 2004, 2009 of JP Morgan. Okay, let me go into the theme of today's. It was a couple of weeks ago, Eddie kindly invited me and Arthur invited me to chair this session. We intend to talk about the interplay between micro-prudential and macro-prudential policy objectives and the use of tools, the design of tools to address those policy objectives. There are lots of interesting issues, important issues, both in terms of design and usability in practice on this theme. But the situation, as I mentioned, in the US recently and more recently in Switzerland has caused me to lose quite a bit of sleep. And I was thinking whether you would still be interested in talking about buffers. And of course, having consulted my panelists this morning, we should say we don't think there is such thing called the best time to talk about design and usability buffers. Anytime is a good time, right? In times of stress, you say, I'm too busy, I've got other things to do. In good times, you feel complacent. You say, we shouldn't be worried about it. We still have time. So we decided we should continue to discuss the theme, but there's a big but. If time allows, towards the end of this 75 minutes session, we would like to talk about a little bit about the current market situations. And we, I think, have a very representative group here, and they will actually be sharing the perspective with us. All right, I hope you would enjoy the session. As Eddie said, and also I think elaborated by Pablo, capital buffers, the Basel III buffers, are important, I suppose, framework to enhance the resilience of individual banks and the system, the banking system as a whole. We do have the capital conservation buffers, which are supposed to be a buffer that a bank can dip into in terms of something bad happen to it. We also have a systemic wide counter-cyclical buffers, which can be deployed when the economy, the macroeconomic conditions or financial cycle go into difficulties, then this will be deployed. Today, we will not talk about the capital conservation buffer. We will spend time to talk about the counter-cyclical buffers, because that's a key point on the interplay between micro and macro-prudentials. The first point is that, which is Pablo mentioned, that 8 out of 27 BCBS jurisdictions has set a non-zero countercyclical rate. And I think almost all of them, understandably, deployed, released a buffer during the very tough times of the pandemic. We are still struggling with the recuperation from pandemic, but adding to it, we have this geopolitical situation in Ukraine, which has serious disruption on the supply chain. And then we have recent banking situations. And of course, rapid rise of interest rates globally. But the point Pablo mentioned is very good. You can't use something you don't have, right? That's the issue. The first issue I want to seek the panelists' comments. Only 8 out of 27 jurisdictions set at about zero. It could be 1, it could be 2, it doesn't really matter. But when you have zero, that during the downturn of the economic cycle, you don't have anything. So we have witnessed that in some jurisdictions, the supervisor have actually adjusted or relaxed the micro-prudential standards to actually enable banks to continue to provide credit flows to households and corporates, right? And this is probably not the kind of intention when the buffer was designed. So my question for each of the panelists is that, do you think moving forward, we should strive in terms of a common Basel standard, a non-zero countercyclical buffer rate so that it could be deployed in times of need? Can I start with Vicky?
Yes, I mean, thanks, Norman.
So you need to use microphone.
Yes, thank you, Norman. Thanks to the HKMA and Arthur and Eddie for having me here. Happy 30th birthday. I can observe that certainly the HKMA has been standing on its feet even at an earlier stage than Confucius suggested. So in answer to your question, Norman, I can only speak, I will try to give you our reflections from the Bank of England. Mm-hmm. So we do have, and we have had for a long time, a cycle-neutral countercyclical capital buffer, which sits on top of the remaining minimum requirements and capital buffers. And its rate at the moment is 2 percentage points, so 200 basis points. We previously, the cycle neutrals setting at 200 basis points was decided in December 2019. Previously, for many years, since 2014, I think, the cycle neutral setting was 100 basis points. Mm-hmm. Now, why did we raise it to 200 basis points? We raised it to 200 basis points because we did some analysis and also looked at some practical experience. And there were two reasons, really. They boiled down to two reasons. The first reason is that policymakers don't have a crystal ball. And the second reason is it takes time to raise capital in a smooth manner. So the original idea of the countercyclical capital buffer was that you would start raising it when risks are above standard in the financial system, when they become elevated. Now, if you look at the GFC as a case study, when did the indicators we now all know start flashing for the UK? Somewhere around 2004. How much buffer would you have needed to have had in order to absorb all the losses that we now know we had? Around 4 percentage points. When did the financial crisis hit? End of 2007 and 2008. It just does not give you sufficient time to raise buffers at these levels unless you start from something positive, and indeed something materially positive. So that is the reason we set it at 200 basis points. Now, COVID taught us another lesson. Indeed, we do not have a crystal ball, because no indicator might flash before you have an exogenous shock, because, of course, the risks we saw in GFC, the elevated ones, were endogenous to the financial system. This was entirely exogenous. So when it did hit us in March 2020, and we had the dash for cash and the crazy volatile asset price movements, we had this cycle-neutral CCYB. And we did release it because the conditions were like the other authorities that mentioned. Now, did this help? If you remember, in this crisis, there was significant support, central bank support in terms of liquidity and material fiscal support. So it is difficult to know counterfactually, in the absence of that support, what would have happened to the banking system. However, at the time, conditions close to the COVID stress, financial conditions had tightened. And we now have very robust econometric evidence from the UK and also from the Euro area. Colleagues in the ECB have done analysis that those banks that benefited more from the release actually were able to support the economy through lending to non-guaranteed sectors by more. And that was in a crisis where effectively the UK banking, the UK bank's capital actually increased in the end relative to what it was before rather than decreased. Yet you see behavioral differences between those banks that benefited more rather than it does. So it does work. Releasing buffers does support the macro economy. So my short answer to you is, yes, you need cycle neutral positive rate. At least this is our judgment, because you don't have a crystal ball and it takes time to raise capital. And releasability of buffers is very useful macroeconomically. Thanks.
Thank you, Vicky. Okay. Makoto-san. It's switch on.
Okay, so sorry. Thank you very much. I also like to extend my thanks to HKMA colleagues for over the past couple of days, with hospitality and excellent room facility, which really helped us discussing a lot of different topics. And as all Basel members know, it's very difficult to talk about capital buffer usability after Vicky. But our situation is actually a bit different, so let me nonetheless try to offer my sort of perspectives. As Pablo mentioned in his speech, the Basel Committee issued a newsletter a couple of times ago on this very subject, and my answer to the questions are all there. So I basically quote from the paper. I support and see benefits in the ability of authorities to set a positive cycle-neutral CCYB rate on a voluntary basis, but situation varies across jurisdiction. So not all jurisdictions, including Japan, doesn't really see that the positive cycle neutral rate to be appropriate at least at this moment. I can understand from a very practical point of view, taking advantage of the current CCYB framework would look really appealing. And I'm really eager to learn from experience of those jurisdictions, including UK, that have already decided to pursue this positive neutral cycle late, so that this does not mean, at least in my opinion, however, at this stage, we should change the CCYB scheme globally so that everybody applies the same logic across jurisdictions. In Japan, the JFSA, our regulator and supervisor, and Bank of Japan, which is my institution, the central banks, are doing a lot of analysis whether we should actually change the current CCYB, but we concluded, at least so far, that the CCYB setting 0 would be the most sort of consistent with the financial stability objective when we see in the credit market, our credit market is actually not really showing any signs of overheating. And frankly, we don't see much benefit at this moment or immediate sort of a benefit from moving to a world to a positive cycle neutral rate, particularly because it would essentially mean for countries like Japan, which is set at the 0 CCYB rate, which means that if you actually try to have a positive neutral rate, it means that we would actually have to live in a world where we have a higher capital requirement on average. And indeed, the Basel Committee actually did a very serious evaluation work in the context of COVID-19, which is acknowledged that the global banking system is now well capitalized, and thanks to the post-crisis reforms, also with the lot of support from fiscal and monetary side as well, of course, but this has helped to stabilize the economy during the COVID-19 episode. And in other words, we have not actually found any evidence that the capital base was actually insufficient, and we should have started with a higher level of capital. We don't have, in my opinion, we don't have that kind of lessons there. So all in all, I believe the jury is still out there to decide if CCYB in the original form around 0%, it's failed to achieve its original objective. But since buffer usability is such an important subject, I agree with everybody, and we all benefit of having a system where the buffer is truly usable. And also, I think our own experience of using this particular tool of CCYB is still not sufficient. We still have to learn a lot. So I'm really willing to learn from all lessons from other jurisdictions. Thank you very much.
Thank you. Wayne?
Thank you, Norman, and good morning, everybody. And like my fellow speakers, Eddie, congratulations, and the HKMA, congratulations on the 30th anniversary. Thank you for the invite, and thank you for the hospitality while we've been here. Also, like my fellow speakers, I'm going to support the option to have a non-zero CCYB, a non-zero cycle neutral CCYB. And I can't really say anything else because we implemented that while I was chair in Australia, so I do it. So I might talk about why we did it, but I do think I quite deliberately said I support the option to have it, and I am a little bit wary, a bit like Makoto, of jumping to a conclusion that there's a new global standard needed. Because I think there will be different needs in different countries. And to some extent, and we might come back to this a bit later on in the discussion, what individual countries need will depend a little bit on what else is in their macro-prudential toolkit. How many other tools do you have? How readily can you use them, etc. So I'm not sure there's a one-size-fits-all, but I certainly support, and we saw benefit in Australia in having a non-zero setting. Now, why did we see that benefit? I think there were three reasons. We implemented a non-zero CCYB as part of our framework, and our non-zero setting is 1%. But there were three reasons. One of those is probably a purely domestic framework, a domestic reason, and two, I think, have general applicability. So the domestic reason was simply, to Makoto's point, we deliberately set out to strengthen our standards over and above the international minimum. That was a deliberate, explicit decision. It was a decision of the government that they wanted a stronger banking system, and so we were tasked to implement something stronger than the Basel minimums in Australia. And there are obviously lots of ways you can do it. You can, change the definition of capital, make that more restrictive. You can raise risk weights, you can raise ratios, you can do all sorts of things. But the CCYB is a kind of a neat way to do it. It's pretty simple, it's pretty transparent, and compared to some of those other options to strengthen capital requirements in the system, it doesn't do too much to upset comparability, particularly international comparability. So it wasn't the only thing we did to strengthen the standards, but it was an important part of implementing some higher capital higher capital requirements in Australia. The two more general points, though, that I think were behind our thinking was, first of all, we really wanted to strengthen the flexibility of the framework. And the point's already been made before about, you can't use a tool that you haven't got. We always think about good supervision is counter-cyclical. In good times, you're trying to damper enthusiasm and exuberance, and in bad times, you're trying to support the system through. And equally, the regulatory framework, we were looking ways to make the regulatory framework more flexible and able to be used in more of a counter-cyclical way. And the CCYB, it provides that counter-cyclical tool that can be used when you need it. And as Vicky made the point, we've recently seen the need or a set of circumstances where the traditional or the original thought process that you would use it purely in response to credit cycles, we've seen it's actually got a broader use. And then the third reason, beyond strengthening the standards and increasing the flexibility in the standards, was at the time we were thinking about it was sort of conceptual, but what we've seen in the COVID period, I think, is very practical and real. And that is that having a buffer that you can release in very clear way really improves the clarity of communication about what regulators are doing. So if I contrast what I was doing in Australia with what the Bank of England and the HKMA were doing in the early stages of COVID, we were all, allowing banks to use their buffers. But jurisdictions that had a buffer in place and could release it were much clearer on what they were doing, what was being done, the size of what was being done, the estimate of what impact it would have. Whereas those at that stage in 2020, we didn't have the buffer, and while we could talk about it's okay to use your buffers that have been built up, the clarity and the precision about, well, exactly how much can we use and exactly what impact will it have was much, much less. So I think those jurisdictions that had the tool and were able to release the tool had, my view, were much more effective in their communication about what they were trying to achieve and what impact they were hoping to have. So they'd be my observations. Thanks.
Okay, thank you, Wayne. Bill, you're at the receiving end. To lots of people, buffer ratios as numbers, but capital carries cost, sometimes expensive. So tell us, what do you think?
Good. Well, first of all, thank you for having me. And thank you, Eddie and Arthur, for hosting this. Of course, it's slightly intimidating to be here amongst this group of central bankers and regulators talking about a very technical matter. So rather than add some technical thoughts, of which I have very few, I thought I would add some impressions in terms of how we receive these policies and this wisdom, and how it causes us to adjust our behavior. So it seems broadly that the countercyclical buffer breaks down into the impact that it will have on behaviors and the impact that it will have on signaling and maintaining confidence during times of stress. That's the framework in which I would consider this. From my perspective as the CEO of a bank, the capital buffers in aggregate are not a binding constraint. So already, I say it doesn't really matter. Today. Obviously, it could matter at a different point, but it doesn't really. The binding constraint for us is our own economic risk modeling, the rating agencies' view of our capital at risk and liquidity at risk, and the stress test, the regulatory stress test, which include, obviously, our own economic modeling is based substantially on stress scenarios, not exclusively. But of course, we have Bank of England and other stress tests for the markets in which we operate. In my now almost 8 years at Standard Chartered Bank, the binding constraint has regularly been the Bank of England stress test, and that's looking at the peak to trough drawdown, of course, taking us well through, and the bottom end of these very severe scenarios, well through all the buffers that have been set. Right? But with an understanding at that point vis-a-vis our regulator that we're either, well, when we get a grade, right? We either pass, we fail, or we're on probation, or we're on notice, right? That's the messaging that we get. And that's reasonably public. The scenarios are public and the outcomes are public. So that has the effect of contributing to underlying confidence or not. So I think from a behavior perspective, we have regularly run well in excess of the buffers that are required because of our own economic modeling and because of the stress test. So I guess implicitly there, you would not expect me to stand up here and say, please give us more buffers and we want to carry more capital. We want you to tell us to carry more capital. You wouldn't expect me to say that, and absent anything else, I won't say that. I would say that implicitly, the greater than zero countercyclical buffer through the cycle makes sense. That's the way we run our bank. That's the way most banks run their banks. And so I can't disagree with Vicky or Wayne or the considerations from Makoto-san. But that said, I'll stop there in terms of what I'm asking for. In terms of signaling, I think it's extremely important. And we saw during COVID, which was a genuinely macro and across the board systemic shock, that the simple message that our regulators were prepared for us to draw down our capital ratios in support of the real economy. Of course, that might have been through losses or increased provisioning or increased RWAs through stepped up lending, or a combination of the three, which was in fact the case. The signaling that that's okay helps maintain confidence. And the stronger position you start from, the stronger confidence signaling you can deliver. So I'd say from that perspective, it's quite important. I know, Norman, you said if we have time, we'll talk about the market events later. But as I sit here today, even more so than when I sat here 2 years ago or 3 years ago, thinking about the environment, the issue isn't so much do the regulators have confidence in our solvency, it's does the market have confidence in our liquidity. That's just, it's perfectly obvious. And I'm afraid that the market and regulator reaction to these 3 bank seizures that we've had, and possibly there will be more combinations of banks, forced or otherwise, the acuteness of the awareness of the liquidity sensitivity has increased dramatically. So the signaling impact will be even more important than it was before.
Okay, then I have one short answer from each of you. Are you, in general, supportive of a global standard for a cycle neutral rate above 0? Vicky?
So my position.
Your microphone.
So my position is quite similar to what Wayne has said. I mean, as you know, Norman, at the moment there is no global standard for the setting of cycle neutral, and I understand Makoto's views that, for example, if they think that capital overall in the system is sufficient and they have additional resilience, putting up another cycle-neutral CCYB might lead, in their view, to suboptimal levels of capital. So I think there needs to be an option. In our view, as the Bank of England, we did, when we started using the cycle neutral, it was post-GFC. It was on the back of an assessment of what an economy like the UK, which is a medium-sized economy, but has a vast financial system, how much optimal capital levels should be. They should be above baseline international standards. And therefore, we built up a cycle neutral. That was our estimation of the resilience, the overall resilience that it has. It has proved very useful for the reasons I set out, but also exactly as Wayne and Bill said, for the signaling value. The signaling value, the communication value has been extremely important on that front. So that's where I am. It's an overall capital decision. We can have a very long debate whether what is the level of optimal capital. Indeed, that has been had, which is appropriate for different economies. But that's
Okay.
a short answer.
Okay, short answer from Makoto-san.
I acknowledge the importance of signaling sort of effect, but still, as I said before, if we have to have the international standard, this voluntary basis thing is very important to take into consideration different situation across jurisdiction.
Okay, Wayne.
I'll just repeat what I said before. I think it's really important the option is there, that it's clear in the framework, and that the committee statement last year that said it's perfectly legitimate for jurisdictions to be applying a non-zero neutral rate, and that's consistent with the framework. I think that's a good position to be.
Okay, Bill.
Not a top priority. There are many other far more impactful discrepancies between the application of the BCBS rules that are much more concerning to me.
All right, okay, let's move on to a related but important subject. We talk about interplay between micro-prudential and macro-prudential objectives, policy objectives, and then you have to talk about the toolkit. You need to talk about powers to require banks to implement certain standards. But in different jurisdictions, there are different institutional arrangements. In Hong Kong, for banking system, we have the HKMA. It's like the MAS, where the conduct, the prudential, and the financial stability mandate rest with one organization. So, of course, they require a coordination, something I want to hear from Vicky. You do have Bank of England looking after both financial stability, the macro objective, as well as micro-prudential objectives. In Japan, Makoto-san talked about BOJ, of course, a key stakeholders and maker, gatekeeper but you have JFSA as well. Similarly, in many jurisdictions, they have separation of two independently organizations. And then in Australia, of course, you have APRA, you have Conduct Authority, you have Reserve Bank of Australia. Something will be interesting to hear from Wayne as well. And then lastly, Bill, you can talk about, again, at the receiving end, how does it feel like in terms of meeting all this micro-prudential, macro-prudential, but they all translate into specific requirements, standards, powers that you must comply. In addition to you have to appease the rating agencies and your shareholders. Why don't I start with Makoto-san? You first. Talk about your situation in Japan. How do you ensure these two sets of policies are coordinated, implemented, and how do you address potential tensions that arise from it?
Thank you very much. I feel an interesting connection here because it was like a couple of years ago, I had this same discussion with you under a different capacity in the FSB meeting here in Hong Kong. Well, I remember we discussed at that time, IMF, BIS, and FSB actually issued a paper on the macro-prudential framework. And we actually discussed a sort of an early implication for Asian economy. And I have to admit that the Japanese institutional framework at that time was still nascent. And over the past decade or so, our system actually evolved quite significantly. And as Norman mentioned, in Japan, CCYB, it's set by our regulator supervisor, so JFSA, so the official power lies with our banking supervisors, our good friends always. But we also have a framework in place with the JFSA, and the BOJs are actually in touch with each other to assess the stability and soundness of the entire financial system, including the CCYB and other macro-prudential analysis in general. So we publicly acknowledge that on this front, it is the central bank, the BOJ, will play an leading role with closely coordinating with the JFSA. So the bank holds a meeting of what we call the Council of Cooperation and Financial Stability, where senior officials from both institutions, including the commissioner of the JFSA and deputy governor from our side, participate. And to support our discussion at this high-level forum, we have a sub-layer of groups, including some technical group or assisting some analysis here. And if we come to think of it, in pursuing macro-prudential, our objective we really need to take into a system-wide impact. We really need to think about our forward-looking perspective, because whatever you do on this plot, there will be a lags for the policy to take effect. But such an approach is exactly what we do in terms of monetary policy. So there is a lot of our affinity here. And indeed, looking back the history of central banking, I think most of the central bank that was actually established before the World War II were actually created with the objective of stabilizing the financial system after it had been in turmoil. So that's the macro-prudential perspectives, and not something very new. Or the Pablo alluded in his speech that it's not actually a post-crisis inventions, but maybe it actually rooted in the fundamental needs from the society on the needs for the central banking. All central bank operations, issuing banknote, operating payment and settlement system, lender of the last resort, and conducting the monetary policies are all ultimately not free from macro-prudential perspective. But this does not mean, I have to insist, this does not mean that the central bank's view should always prevail. Our banking supervisors and central banks have different areas of expertise. And many may naturally have different views, but I think that's okay. Because it is precisely because we have different views that we can actually lead to the deeper understanding of our situation. We often say in Japanese, looking at things from different angles allow us to have a three-dimensional view of a particular things so that you can actually better understand the system. What is important is each to have a framework for exchanging views and complementing each other's strength and creating synergies. And indeed, BOJ and JFSA have been conducting a series of joint exercises, and particularly in the area where we think is the most important in maintaining financial stability. So let me give some recent example of the recent sort of initiative is like a stress test, supervisory stress test jointly based on a common scenario, joint survey on foreign currency and liquidity management and cyber risk management, as well as a pilot exercise of climate scenario analysis. So as long as both supervisors and central banks are committed to such a process, I think it seems to me who has the final say may not be the most important questions. Thank you very much.
Can I ask for a question? If there's a major disagreement or major issue, how do you resolve? You refer to Ministry of Finance or the Prime Minister? Because you're loggerheads, all right, but there's something important, it's not something, how do you do it? How do you
Fortunately, we haven't seen any situation where there's a very big conflict. I think it should, if that should happen, then it's going to be resolved within this coordination scheme or between Bank of Japan and the JFSA. There was no official role for the ministry and other people. But it's ultimately the final decision will rest on the JFSA, and I think it's okay.
Because it has the powers, the legal powers.
Yeah.
Good. Wayne, can you talk about Australia?
Yes, thanks. So I'd just say up front that I don't think there's any right answer to this question. It depends on a number of things that are about each jurisdiction. Each jurisdiction will have a different architecture. So I think, first of all, it does depend on legislative authority and who is actually ultimately responsible for financial stability. And in Australia, APRA, the prudential regulator, in its establishing legislation, has a statutory objective to promote financial stability. That's one of the key objectives of the organisation. The central bank, the RBA, doesn't have that explicit in its objectives. It has, a general objective about economic prosperity of the Australian people, and it can read into that. Obviously, financial stability is an important part. But at least in the Australian context, the way the legislation is set up and then the way the tools are assigned, essentially it is with the prudential regulator, like Makoto in Japan. And to preempt your question, what if there's disagreement? Well, I think we would just resolve it with transparency in the sense that the head of the prudential regulator is ultimately responsible and accountable for the decisions that are taken. And I think that gets to sort of the second point. So the first thing that determines who does what is the sort of legislative framework that enables you, gives you powers and responsibilities. Then there's a question about what else is in the toolkit. And I think as much as possible, you should be designing the toolkit and giving as many of the tools to the one authority. And ideally, you give it to the authority that has the accountability. And then, so there's the legislative framework, there's the toolkit, and then there's really what I call the objectives. And there, I think you've got to have a good understanding about what macro-prudential is and why you're using it. And certainly over the years, I think the term macro-prudential gets sort of bandied around a lot. And at least in my time, I've seen things that are neither macro nor prudential, but nonetheless, they're called macro-prudential because it sounds good and, of course, very important. But there is, I think, been a shift in recent years. And if you go back to when the CCYB was first put in the Basel framework, and you look at the language, it was about building resilience to cycles, protecting the banking system from the broader financial system and financial cycles. Now we talk about macro-prudential tools much more as a macroeconomic stabilisation instrument. And I think if you are not clear about how you're using it and the objective that you've got, what purpose you have in using it, then it's hard to work out who should be pulling the levers. So I don't think there's any answer, but I think you have to look at that. What is the legislative framework that gives authority? What are the tools and who's accountable for using them? And then what's the purpose, what's the objective of using them to decide who should do it? Whatever that allocation of responsibilities, whether it's to the central bank, to the supervisor, to the Ministry of Finance, absolutely coordination is important. And so, we all know the scenario that that we worry a lot about is that someone wants to pull the macro or push the macro-prudential lever one way or the other, and through micro-prudential actions, there's something conflicting or contradictory going on. And that obviously can seriously undermine the effectiveness. So what I would say is I think as much as possible, you actually want to put the macro-prudential tools and the micro-prudential tools in the same organisation, whatever that organisation is. It could be a central bank, it could be a supervisor. Because I don't really think at the end of the day, maybe I'm going to now sort of contradict something I've just said, but I don't actually think there's a box of macro-prudential tools and a box of micro-prudential tools, because micro tools have macro impacts and macro tools have micro impacts. You have a problem, it may be a macro problem, it may be a micro problem, and you have a toolkit. And you might use the tools in some innovative ways without getting sort of too fixated on what label you've attached to it.
Yeah, okay, thanks a lot. I think in Australia's case, the legal powers rest with APRA.
The prudential regulator.
Prudential, which is tidier, I think. But I think the problem remains because the central bank, very few of them would say, I have no role in maintaining financial stability. And also the government, the executive arm, would say, look, I'm the overall guardian of the entire economy, well-being of the society. And therefore, they would want to have a role to play in assessing and also doing something, pushing the lever.
Yes.
But the powers rest with a organization which is sort of separate, independent, and therefore the potential conflict situation may arise.
No, but that's right. But I don't think muddying accountabilities helps resolve that.
Yeah.
That we have the same body that is in Japan. We sit around a table, the Council of Financial Regulators with the central bank chairs it, there's us, the conduct regulator and the Treasury. And we have publicly committed, I say we, I'm not there anymore, but APRA publicly communicated and committed, we do not exercise macro-prudential policy tools without consulting with those other agencies at the table.
Yeah, but that committee is chaired by the governor of the Bank of Australia. Okay.
Yeah.
Let me hear from Vicky before I go to Bill.
Yeah, thanks. Listen, I can talk about our experience, and then I will come to the sort of normative question: is there an optimal institutional framework here? So, in our experience, how are we set up? So we have obviously, as the Bank of England and as most central banks, a monetary policy function and objective as an operational independent central bank. Separately, we have a macro-prudential committee within the central bank, which has another objective and is accountable for financial stability, pursuing financial stability. And then third, we have the micro-prudential authority, which is the PRA, which is responsible for the safety and soundness of individual institutions with a view to facilitate financial stability. And these arrangements, monetary policy independence predated the financial crisis, but these arrangements were set up post-GFC, and the statutory objectives were post-GFC, in order to have both accountability, but also for them to sort of work together in this word that I don't like, but I'll use it, holistic kind of fashion. The central bank governor chairs all three of these functions: the monetary, the macro, and the micro. Now, but each of these committees has also got independent members that are non-overlapping, but it's got also some overlapping executive directors or deputies, but also independent members that look at these objectives. Now, how has the other point that I have that is quite important is that in our system, the macro-prudential committee can give recommendations and directions to the micro people, but not the other way around. So there is a hierarchy. Ultimately, the UK Parliament has decided that the macro economy ultimately needs to be obviously above any particular micro considerations that involve individual institutions. So that's how the framework works. Now, how has it worked in practice relative to the arrangements that we had before? And I've been around for quite some time, and I was actually involved in setting up some of this after the post-GFC. I mean, the macro-prudential authority was set up in 2011. The PRA was created from a split of the previous Financial Services Authority in 2013. So I'd say between 2011 and 2013, when actually the micro and the macro was sitting outside, there were probably more frictions than afterwards. Now, it is difficult to say whether this was in view of the institutional arrangements or whether it was because of the particular context at the time. Because it was a period where the euro area crisis was going on. It was post-GFC. The macro-prudential authorities were very focused in building up resilience in the financial system as quickly as possible. And the micro authorities wanted to do it in a particular way. Since then, I mean, the experience over time has really, really improved, and it has proved extremely useful in particular events. First of all, as Bill said, currently the binding way of setting capital in the UK for the major UK banks, and indeed for the smaller ones, is through stress testing. We do, for the major UK banks, we do an annual stress test. The scenario for it is set by the macro people, but in coordination with the micro people, and it's explicitly counter-cyclical, and takes into account the particular CCYB setting that the macro authority deals with. But it is entirely also informed by the risks that the micro supervisors see on the individual big banks that we have, some of which are globally systemically important banks. So their problems in these banks could have problems for the system. Now, this joint operation ensures that the binding requirement, that is the stress test, will never result in capital that is below the CCYB and will never offset the CCYB policy, but also helps set up individual capital for idiosyncratic reasons, for bank-specific reasons, set above that. So they're individually, so the system is counter-cyclical, but it has mechanisms to avoid offsetting. Now, could all of this have been possible if we were not in the same institution? It might, with good coordination and with no coordination frictions. Everything is possible. So therefore, there isn't perhaps an optimal institutional setup. But like Wayne, in practice, the fact that we are in the same institution has worked in terms of frictions. Now, should this institution be a central bank? This is interesting, and I think that comes to the other functions of the central bank, which include monetary policy. Now, recently, I think Pablo might have mentioned it, or Eddie actually. Eddie referred to the LDI crisis, which was quite recent, not as recent as the events we are seeing over the last 2 weeks, but pretty recent, and very recent in my mind. Now, there, it was an event that was triggered by kind of rising interest rates and a particular fiscal event amplifying it in the UK that led to extremely volatile conditions in the government bond market. that had consequences for a non-bank sector, this leveraged, this LDI sector, which the macro-prudential authority has a role in, because the demise of that sector would have meant that the government bond markets would have been entirely dysfunctional, which would then have consequences on the banking system, which the PRA supervised. So a macro-prudential, for financial stability reasons, decision was taken to support the government bond market for financial stability reasons, because otherwise there would have been dysfunction. But that happened in the context of, and that also was helping potentially the banking system as well. But that happened in the context of a tightening monetary policy environment. We were injecting liquidity in the system for financial stability reasons in a tightening environment, which was one of the reasons the governor of the Bank of England was pretty clear in all his communications that the support was temporary and that the LDI institutions had to deleverage and sort themselves out because there was quantitative tightening. So it's not only macro and micro, it's also macro, micro, and monetary policy. And at the moment, going to the events that we're actually saying, both our macro-pru people and our micro-pru people with their device advised the Monetary Policy Committee of the Bank of England, which made a decision about interest rates last week, about their assessment of what is happening. And all of that coordination helps. But it does not mean that you have a unique institutional framework. A final word about treasuries. There is a reason why monetary policy sits with independent central banks, and economists call that time consistency. And it's basically to avoid, governments have incentives to do certain things for political reasons that well, there's exactly, and there's quite a lot of literature on this, there is, and evidence, there is the same rationale for macro-prudential policy could be also set up, that this needs to be with an operationally independent institution. Thanks.
Okay, Vicky, as I promised at the beginning, we would actually spend some time. We have over slightly 12 minutes for this session. I would like to, Bill, right? Can you share with us what you hear, the market reactions, sentiments, the most recent banking events in the US and Switzerland? Bill?
Yeah, obviously it's all happening somewhat real time, but it's, I think that there are a number of lessons that are already coming through pretty clearly. First is I'm going to state the obvious, the importance of proper liquidity forecasting. And I put myself in the position of the head of the Asset Liability Management Committee at Silicon Valley Bank, and wonder what was he or she thinking about that concentrated deposit base. And of course I don't know, but I'll bet they thought those deposits were pretty stable. And these are good customers of theirs that have been around for a long time, that had funded the bank from the beginning. Why would you assume that they would all disappear at the same time? I mean, the importance of stress testing. The second was the consequence of that misforecasting of deposits obviously was an interest rate mismatch that when forced to raise liquidity became acute. Third was the lack of operational resilience. They were unable to repo their treasury bond portfolio. That's a pretty fundamental gap in a bank's asset liability and liquidity management. So we will all reflect on that, and no doubt the U.S. and other regulation will adjust to reflect that. But obviously the next step in the process was the guaranteeing of non-FDIC insured deposits. Okay, that sounds like just the most wonderful example of moral hazard that we've come across in quite a while. And then extending that to the entire U.S. banking system through this highly concessionary liquidity facility. I love the idea of repoing my treasuries at the Fed at face value when they're trading at 75 cents with no haircut. But I mean, this is quite a dramatic reaction. And we can all say that the Credit Suisse situation was independent of what happened in the U.S., but it's not. And at the end of the day, the common feature was a lack of confidence. As I step back and reflect, I'm of course curious to get the views of everyone here on what the long-term consequences of this set of actions is. And I say it's real time because there obviously are some what would appear to be non-viable business models remaining, at least in the U.S., with other banks that have similar deposit concentrations. There have been various programs, and banks have stood up and made big deposits into these banks, which has then caused their share price to collapse because it's viewed as actually a vote of no confidence in their business model, although there's confidence in the liquidity, or maybe it's confidence that the Federal Reserve will bail them out when push comes to shove. I think my observation about the three banks that have failed is that they would appear to have been solvent. They would appear to have been solvent. Of course, I don't know that. I don't know that the regulators know that, but every indication is that they were solvent. They had liquidity runs for reasons that we could all explore, and they were seized. And in the case of the Swiss bank, the AT1s were wiped out. There's been a lot of focus on the hierarchy question. That's interesting. It's important. It's not the big question. The big question is, how do you wipe out $17 billion of AT1 in a solvent bank without a review process? I think that had very profound implications for the regulation of banks and for the way that banks manage themselves. So these are the questions that I'm sure you all have answers. We're developing our own answers for how we avoid being in that position in the first place. It definitely involves carrying even more liquidity. When we had 147% LCR before the crisis, I can tell you that it's substantially higher now, before all the problems. And we would normally have reduced back down to something closer to 140 or 150%. I doubt we will now. We were very well capitalized before this all happened. Of course, we're accruing capital. Bank earnings are still quite good. We're highly unlikely to reduce that capital at this point. And you may say that's what you're supposed to do in the back of a crisis.
Okay, thank you, Bill. Wayne, can I hear from you? You're furthest away from the scene of action.
Yeah.
Europe and Switzerland and the United States. Tell us, what do you think?
Well, I think it's also fresh that I only actually have one conclusion that I draw from it, and that is that I retired at the right time. But I had sort of 5 questions, I think are really important questions that we all should be asking, particularly the international regulatory community should be asking, and I don't have the answers for them, although they do tie into bills. So when banks fail, although Bill might challenge the term failure, you deliberately used the term seizure, but when banks get themselves into severe difficulty that regulatory intervention of the type that's been required is needed, then inevitably there will be questions about some aspect of regulation or supervision failed. I think it's always the case that question can only come after what were the failings in the bank in the first place, and we shouldn't ever think that somehow supervisors and regulators are the first line of defence here. But we should genuinely be asking ourselves, what did we learn from the regulatory framework? What did we learn about supervision processes? And even if there were no failures or mistakes in that process, how do we strengthen them and how do we learn from that experience? And the Basel Committee, I think, has got an important job here to help take those learnings and disseminate those learnings, particularly amongst the large number of countries, including in the Asia-Pacific area, that are not members and are not sitting at the Basel Committee table. So very important role there, regulation, supervision, what can we do better to try and avoid next time? Second question, what's systemic? We put a lot of effort since the GFC into coming up with a definition of a global systemically important bank. We all have definitions of domestic systemically important bank, but I think, and having those definitions is better than not having them. But I think what we all know is the definition is actually cycle dependent, and that's not part of our framework in any way, and so we have to think harder about that. The workings of bail-inable capital instruments, as you've touched on, did they work as intended? Yes or no? And regardless of what the answer is, yes or no, having had what's happened, will they work as intended in the future? which I think is your point, Bill. Fourth one, which is not really for the Basel Committee, but as Bill touched on, the whole design of deposit insurance, I think now has to be rethought. Will it work? What are the right thresholds? And most importantly, if coverage is going to be extended, it can't be a free option to the banking industry because otherwise we're just distorting incentives. And so how do we get payment if we're going to find ourselves in situations where more deposits have to be covered by deposit protection, whatever form that protection takes? And then the last question, or the last observation and question, is a little bit cheeky coming from Australian, but as a jurisdiction which has a capital requirement for interest rate risk in the banking book, it can be done. It provides a really good incentive to manage that risk properly, and it's probably a bit of a gap in the Basel framework still. I'll stop there.
Thank you. A lot of work for Basel Committee, Pablo. So it's a perpetual industry. So before we know it, we have Basel 4 and then 5 and 6. Anyway, Makoto-san, any comments from you, from the BOG?
No, I think it would probably be misleading to say anything definitive at this moment, but I think two issues are important. Some of them are the issue that Wayne just touched upon. And first of all, we really have to continue to coordinate our, work together with authorities around the world to closely monitor bank and market development. And another thing is, of course, we will have to take stock of obligations to learn lessons. And one of the things that I'm really glad to see is that the Basel Committee, we kept on meeting virtually for a very long time. We only initiated our in-person meeting sometime last year, and this is the second time. But it's really important to have this kind of forum, where everybody can get together and discuss your issues. Sometimes we have disagreement, but it's a very candid sort of our forum where everybody can bring their own insights. So I think that's kind of a good cooperations are quite important, as always.
Yeah, I think Wayne raised those questions. I do think they're all relevant to the Basel Committee, even the fourth question. But anyway, I think it would take some time before some of the answers can emerge, right? It's not something that you will have immediate so-called solution or answer, and that's how life is. Anyway, Vicky, tell us, you are in a sort of center stage. You did something to SVB subsidiary in the UK.
Yes, we did do something to the SVB subsidiary. I mean, before getting into this, I mean, just to say, Norman, I really agree with you. I mean, things appear to have calmed down, but we need to make sure that we are completely through this before we can draw all the lessons that we need to learn, and indeed banks need to learn, because as Wayne said, and ultimately they manage the particular institutions, but also regulators, supervisors, central bankers in terms of the facilities, governments, and so on. However, there are some, issues that have already sort of emerged, and I do agree with Wayne highlighted a list that is likely to persist, I think. There might be things that are added to it. Another issue into this list, which is related to interest rate risk in the banking book and how you capitalize for it, is basically the relationship between accounting rules and how much of your book you can hold, you can choose to hold in terms of hold to maturity and not mark to market your securities. The flightiness of your deposits and the degree that they're uninsured, and what does that mean for the embedded losses you actually have. So there are emerging lessons. I mean, in terms of the UK situation, the Andrew Bailey, the governor of the Bank of England, wrote earlier this week to Parliament, to the UK Parliament, to the committee that oversees the Bank of England called the Treasury Select Committee, setting out what happened with Silicon Valley Bank and also setting out exactly how our system operates. The letter has been published, but effectively with Silicon Valley Bank, it was kind of a textbook resolution. The resolution regime worked exactly as it was designed to work. It was the first actually resolution in 12 years. Initially before the purchaser, which was HSBC, came, there was no purchaser, and on Friday evening, because it was clear that the US authorities had already taken over the parent, and frankly speaking, without a parent, there were also there was no viability for the subsidiary, and already liquidity outflows had started on that Friday. Our initial view was that this particular bank was not systemic, it didn't have critical functions, so it could go through the insolvency procedure, but pending other developments. Other developments appeared, and therefore we used the resolution system to transfer the bank to HSBC. We completely respected the hierarchy of capital instruments, so equity was wiped out, 81, and then senior debt. So it was a straightforward textbook resolution. And beyond that, the financial system of the UK, probably because of some of the actions I described earlier, remains very resilient. Sort of LCRs, Bill mentioned about the Standard Chartered one, on average for the major banks are 149%, NSFRs of 136%, and liquid asset buffers are 1.4 trillion pounds, six times the amount of at-cost securities that you have on the balance sheet. And actually out of this 908 billion, of the 1.4 trillion is actually in cash and central bank reserves. So our system is very resilient, has a CET1 ratio of 14.6% for the big banks, 18% for the small banks. Thanks.
Well, I think it's very comforting to know. I think while discussion getting more and more interesting, like most good things in life, has to end because we have run out of time. We are already 3 minutes sort of over time. So I would just like to invite all of you to join me to give a big hand to our panelists.